If the US dollar stopped being the world's reserve currency, your rent wouldn't change overnight, your paycheck wouldn't disappear tomorrow. But the system underneath everything you rely on would begin to shift. Slowly at first, then structurally. Because the dollar isn't just money, it's infrastructure. And if that infrastructure weakens, global power rearranges. Stay until the end, because we'll break down what reserve status really means, the true strengths and vulnerabilities of the dollar, why BRICS nations are exploring alternatives, and how to position yourself if the system transitions. Know the system. Don't be used by it. Leverage it. A question is quietly gaining traction in financial circles and government offices, and even at kitchen tables around the world. Will the US dollar, the undisputed king of global finance for nearly 80 years, lose its crown? This is not about a sudden dramatic collapse you might see in a disaster movie. Instead, it's a slow, deliberate, structural shift in the global order. For decades, the world has operated on a system where the dollar is the central gear. What if that gear becomes smaller, or other gears grow to rival it? That's no longer academic. It affects your savings, the cost of goods you buy, and the stability of the global economy. Today is 2026-02-18. The currents of change are more visible than ever. The conversation has moved from the fringes to the mainstream. The world is changing. Emerging economies, most notably BRICS, Brazil, Russia, India, China, South Africa, and now others, are reducing reliance on the dollar. Their motives: greater economic autonomy and pushback against dollar-based geopolitical leverage. At its simplest, a reserve currency is a foreign currency that a country's central bank holds in large quantities as part of its official foreign exchange reserves. Think of it as the savings account for an entire nation, but held in someone else's money. Countries don't hold these reserves just for show. They are essential for the smooth functioning of the global economy. They use these reserves to pay for international debts. They use them to purchase critical imports. Oil medicine. It also serves as a reliable tool to manage their own currency's value. If a country's local currency is falling too fast, its central bank can sell some reserve currency to buy its own, propping it up. The US dollar is, by a wide margin, the world's primary reserve currency today. The dollar's role extends far beyond central bank vaults. It is the dominant currency for invoicing international trade. Brazil. When a company in Brazil sells coffee, Vietnam, to a buyer in Vietnam, the price is very often set and paid in US dollars. This simplifies transactions, creating a common language for global commerce. Furthermore, key global commodities, most famously oil, are priced in dollars. This is a legacy of agreements from the 1970s. This means any country needing to buy oil on the world market must first acquire dollars. This creates a constant structural demand for the US currency from virtually every nation on the planet. This widespread use creates what economists call a network effect. The more people and institutions use the dollar, the more useful it becomes for everyone else to use it too. It is the currency for most cross-border loans. It is the currency for corporate bonds issued outside a company's home country. It is also the world's preferred safe haven asset. During times of global crisis or uncertainty, investors and governments alike tend to flee to the perceived safety of dollar-denominated assets, particularly U.S. Treasury bonds. This reflex reinforces the dollar's dominance, creating a self-perpetuating cycle of trust and reliance. So when we talk about the dollar's exorbitant privilege, this is what we mean. The United States can borrow money more cheaply because there is a huge global appetite for its debt. It can also pay for its imports in its own currency, insulating it from the kind of currency crises that can devastate other nations. This global demand effectively means the rest of the world is helping to finance U.S. government spending and trade deficits. It is a powerful position, but one that also comes with immense responsibilities. Maintaining the trust that underpins this system is paramount, and any erosion of that trust is what puts the dollar's status at risk. The US dollar did not become the world's dominant currency by accident. Its rise was formally cemented in 1944. Delegates from 44 allied nations gathered at Bretton Woods, New Hampshire. They met to design a new international economic order. Their goal was to avoid the economic chaos, currency devaluations, trade wars. Those were forces that had helped cause the war. At that time, the United States was the world's undisputed economic superpower. It held the vast majority of the world's gold. Its industrial base was untouched by the war, and its economy was larger than any other. The resulting Bretton Woods Agreement pegged other currencies to the US dollar, and the US dollar was convertible to gold at 35 per ounce. That system put the dollar at the center of the global financial universe. For nearly 3 decades, the dollar-gold standard gave stability and growth. By the late 1960s, the system came under strain. U.S. government spending on the Vietnam War and domestic social programs led to more dollars circulating globally. Other countries feared the U.S. lacked enough gold to back those dollars. They began exchanging dollars for gold, draining U.S. reserves. In 1971, President Richard Nixon severed the dollar-gold link. Many predicted the Nixon shock would topple the dollar. Instead, the world kept relying on it. Why? Because there was no viable alternative. The U.S. economy remained the largest and most dynamic. More importantly, the U.S. possessed incredibly deep, liquid, and open financial markets. The market for U.S. Treasury bonds became the new anchor. It was, and is, the largest and safest place for governments and big institutions to park money. That market depth was backed by a strong rule of law and property rights protections. Together, they created institutional trust. Another crucial factor was the U.S. Federal Reserve. The Fed can supply massive dollar liquidity globally during crises. This was demonstrated during the 2008 financial crisis, and again during the 2020 COVID-19 pandemic. The Fed established swap lines with other central banks to ensure dollars kept flowing. That lender of last resort role reinforced global dependence on the dollar. Today, the dollar's dominance rests less on treaties and more on market-size institutional trust and the Fed's crisis-fighting capabilities. A couple of quick framing notes before we go on. If the dollar's role as the primary reserve currency were to weaken, it would not be a single event, but a slow-moving process with a clear sequence of effects. The first and most direct impact would be on the demand for U.S. government debt. Today, foreign central banks are among the largest buyers of U.S. Treasury bonds, which they hold as reserves. If these central banks decide to diversify their holdings, perhaps buying more euros, yuan, or gold, demand for treasuries would fall. Basic economics tells us that when demand for a product falls, its price goes down. For a bond, a lower price means a higher yield, or interest rate. A decline in foreign demand would therefore put upward pressure on the interest rates the U.S. government must pay to borrow money. This leads directly to the second step in the sequence: higher borrowing costs for the entire U.S. economy. The interest rate on U.S. Treasury bonds is the benchmark for almost all other interest rates in the country. If the government has to pay more to borrow, so will everyone else. This means higher interest rates on mortgages for homebuyers, car loans for consumers, and credit lines for businesses. This would act as a brake on economic growth. Furthermore, with a national debt already measured in the tens of trillions of dollars, even a small, sustained increase in interest rates would add hundreds of billions of dollars to the annual federal budget deficit, forcing difficult choices between cutting spending, raising taxes, or borrowing even more at those higher rates. The third logical consequence would be a decline in the dollar's value on foreign exchange markets. The constant global demand for dollars to buy U.S. assets and to conduct trade keeps the dollar stronger than it might otherwise be. If that structural demand wanes, the dollar's value relative to other currencies would likely fall. For American consumers, this would mean imports. Electronics made in Asia to cars from Europe would become more expensive, contributing to domestic inflation. On the flip side, a weaker dollar would make U.S. exports cheaper and more competitive on the global market, which could be a boon for American manufacturers and farmers. The effect would be a significant rebalancing of the U.S. economy away from consumption and toward production. Finally, a diminished role for the dollar would accelerate the development of alternative financial infrastructures. The world currently relies heavily on U.S.-centric payment systems like SWIFT for cross-border transactions. A shift away from the dollar would necessitate the growth of new networks capable of clearing and settling trades in other currencies. We are already seeing the beginnings of this with China's cross-border interbank payment system, CIPS, and other regional initiatives. The world would move from a unipolar system centered on the dollar to a more multipolar one, where trade and finance are conducted across several major currency blocks. This would create a more complex and potentially more fragmented global financial landscape. That's the basic outline of how a dominant currency slowly unwinds. Despite growing chatter about its decline, the US dollar's dominance is underpinned by formidable and deeply entrenched strengths. The most significant of these is the unparalleled depth and liquidity of US financial markets. The market for US Treasury securities is the benchmark for the entire world. It is massive, with tens of trillions of dollars in outstanding debt, meaning huge volumes can be bought or sold at any time without dramatically moving the price. No other country or currency bloc offers a single market for safe assets on this scale. For a central bank in Asia, for a pension fund in Europe, looking to park billions of dollars securely, there is simply no substitute with the same capacity and ease of transaction. A second pillar is the institutional framework of the United States. While its politics may be divisive, the country has a long-standing and robust commitment to the rule of law, property rights, and an independent judiciary. Investors globally have confidence that contracts will be enforced and their assets will not be arbitrarily seized. This legal and institutional trust is a form of soft power that has been built over centuries. It creates a stable and predictable environment for investment that is highly attractive compared to the more opaque or state-controlled legal systems of potential rivals. This confidence is a crucial, though often overlooked, component of what makes the dollar a reserve currency. Third, the dollar continues to benefit from its long-established role as the ultimate safe haven asset. It is a powerful paradox. Even when a crisis originates in the United States, as with the 2008 financial meltdown, global capital still tends to flow into the dollar and U.S. Treasuries. This reflex is deeply ingrained in the global financial psyche. Investors are not necessarily betting on the strength of the U.S. economy, but rather on the idea that in a global panic, U.S. assets are the cleanest dirty shirt available. They are betting on the liquidity and security of the U.S. market relative to all other options. As long as this crisis reflex holds, the dollar maintains a powerful structural advantage. Finally, the sheer inertia of the current system is a massive strength. The global financial architecture, from trade invoicing conventions to commodity pricing and the software used by corporate treasury departments, is built around the dollar. Shifting this entire ecosystem to a new standard would be an immensely complex and costly undertaking, requiring coordinated action on a global scale. This is known as the network effect. The dollar is dominant because it is dominant. Without a compelling and clearly superior alternative, the incentive for any single actor to move away from the dollar is low, as it would mean isolating oneself from the world's largest and most liquid network. This inertia provides a powerful buffer against rapid change. While the dollar's strengths are formidable, its position is not unassailable. Significant weaknesses have emerged, providing motivation for other countries to seek alternatives. The most glaring vulnerability is the sheer size and relentless growth of U.S. government debt. The national debt has ballooned to levels unseen since World War II, and fiscal projections show it continuing on an upward trajectory. This raises long-term questions about the U.S. government's ability to service its debt without resorting to politically painful fiscal austerity or inflationary money printing. For foreign creditors who hold trillions of dollars in U.S. debt, the eroding fiscal position of the U.S. is a growing source of concern and a powerful incentive to diversify their holdings. A second major weakness stems from the increasing weaponization of the dollar and the U.S.-led financial system. The use of financial sanctions as a primary tool of foreign policy has become more frequent and far-reaching. While effective in the short term, this strategy has had the long-term consequence of pushing targeted countries and even allies who fear being caught in the crossfire to actively develop non-dollar financial channels. The freezing of Russia's central bank reserves in 2022 was a watershed moment, demonstrating to the world that dollar assets held as reserves were not immune to geopolitical considerations. This has accelerated efforts by China, Russia, and other nations to build alternative payment systems and conduct more trade in their own currencies. Internal political polarization within the United States represents a third and growing vulnerability. The recurring political brinkmanship over the debt ceiling, the risk of government shutdown, and the deep partisan divides on fiscal policy all chip away at the perception of the U.S. as a stable and predictable economic steward. Global investors and central banks prize stability above all else. When the political process in the world's leading reserve currency issuer appears chaotic or dysfunctional, it undermines the very trust on which the dollar's status is built. This political risk introduces a level of uncertainty that was not a significant factor in previous decades, making diversification seem more prudent. Finally, the dollar's dominance creates economic imbalances that can be a source of weakness. The persistent U.S. trade deficit, which is a direct consequence of the world's demand for dollars to hold its assets, has contributed to the hollowing out of the American manufacturing sector over several decades. The most organized and vocal effort to challenge the dollar's supremacy comes from the BRICS bloc of nations: Brazil, Russia, India, China, South Africa. The group has expanded to include major energy producers like Saudi Arabia, UAE. Their stated goal is to foster a more multipolar world order. A key part is to reduce dependence on the US dollar in trade and finance. This is not about creating a single new BRICS currency to replace the dollar. That idea is fraught with immense political and economic difficulties. Rather, their efforts focus on practical, incremental steps to de-dollarize. The primary focus is promoting local currencies for trade among members. For example, India and the UAE have established a framework to settle trade in rupees, dirhams. China has been promoting the yuan to pay for its imports, oil, and other commodities, particularly from Russia and the Gulf states. This process is often called bilateral currency settlement. It bypasses converting local currencies into dollars to complete a transaction. While these transactions are still a small fraction of global trade, they represent a clear and growing trend. The goal is to build a web of bilateral agreements to reduce demand for dollars. They are also building alternative financial infrastructure to support it. China's cross-border interbank payment system, CIPS, is the most prominent example. It still relies on the SWIFT messaging system for many transactions. But CIPS is designed as a potential alternative for clearing and settling yuan payments. The BRICS established the new development bank, the NDB, as an alternative to the World Bank. IMF. The NDB mandates more lending in local currencies. These are long-term projects, but they lay groundwork for a system less centered on Washington and New York. Talk of the dollar's future often falls into a binary trap. Either it remains the undisputed king, or it collapses entirely. The most probable reality is neither. A sudden collapse is extremely unlikely due to the deep-seated strengths and inertia of the current system, as there is no viable successor ready to take the throne overnight. Instead, the world is likely heading toward a more multipolar currency system. In this future, the US dollar will almost certainly remain the most important currency, but its overall share of global trade will gradually decline from its current commanding heights. But its overall share in finance will gradually decline. But its overall share in central bank reserves will gradually decline. It will become first among equals rather than the sole hegemon. In this multipolar world, we would see the emergence of distinct currency blocks. The dollar would continue to anchor the Americas. It would maintain strong ties with Europe. It would maintain ties with parts of Asia. The euro would solidify its role within the European Union. It would also solidify in its immediate sphere of influence. The Chinese yuan would likely gain significant traction as the dominant currency for trade within Asia. It would also grow with countries that have close economic ties to China, especially those involved in the Belt and Road Initiative. Trade between these blocs might still be settled in a neutral currency like the dollar, but trade within the blocs would increasingly be conducted in a regional anchor currency. For the average person, the slow-moving tectonic shifts in global currency hierarchies can feel abstract and distant. You cannot control whether a central bank in Asia buys U.S. treasuries. However, you can control how you position your own finances to be resilient in a world of evolving risks and opportunities. The key is not to make drastic, panic-driven moves, but to adopt a long-term strategy of diversification and awareness. The first and most fundamental step is to think beyond a single currency. For those whose entire financial world is denominated in dollars, this means considering a modest allocation to assets outside the U.S. This can be achieved simply through global or international stock and bond funds, global stock funds, global bond funds. The dollar losing reserve status would not end the financial system. It would redistribute power within it. Reserve dominance is not permanent, but neither is it fragile. It is sustained by trust, liquidity, and infrastructure, and those don't disappear overnight. The real question isn't, will the dollar collapse? It's, how does the system evolve, and where are you positioned when it does? If this breakdown changed how you see global money, don't let it stay theoretical. Like this video to push structural analysis into more feeds. Comment dollar if you think dominance continues. Comment BRICS if you see a multipolar shift. Subscribe to Hidden Systems for weekly deep dives into money, incentives, and global power structures. Because understanding the system is leverage, and leverage compounds.